Good day everyone. This is Dr. Sivaraman of iknowindices.com. I am going to do Tracking the Forex Market Part 2, the webinar, a continuation of Part 1 which was held between 5 and 5:30 GMT during the Japanese session. So let me display the slide. Tracking the Forex Market Together Part 1 on March 19 between 14 to 14:30 GMT. 14 to 14:45 GMT. So I had done the tracking the forex market between 5 and 5:45 GMT, and also I reviewed with regard to the market how exactly the highs and the lows were set, and also taken some positions. And we will now analyze what happened to those positions and how exactly I handled those positions. So you will be able to understand how to use the hedging as a tool or a strategy to limit the risk and maximize the profit irrespective of the market moves. And also I will review with regard to the highs and the lows in each of the currency pairs wherein we have reviewed the market, and give the fresh trading ideas with regard to the US session. So let me go to the slide of the forecast which was given for the Japanese session. Japanese session, Euro and GBP were expected to swing near low and firm up, and they made little bit of firm up and subsequently made the drop. And what happened to the positions I had taken? So these are all the calls I had given during the Japanese session. So Euro, a buy limit order was placed at 1.3600. That was the 1.3599 was the low. Just one pip above, a buy order was kept, and an entry stop of 1.3570 was kept. And subsequently, during the European session, quickly Euro dropped, and 1.3570 was filled, and subsequently the hedging was filled, 1.3570, and dropped further to 1.3550. So I kept stop at entry at 1.3570, and subsequently there was further drop. So I was waiting to see how far they are going to drop it. When they stop cutting the new low, then I wanted to just close the hedging with a profit, and subsequently keep another hedging order below that. So I found that around 13 GMT they stopped cutting the low. Then I kept 1.3540. I closed this sell position at 1.3540 with 30 pips profit, and kept another hedging order at 1.3510. And if you see the current market level, it is at 1.3537, and the low is 1.3526. Still my entry stop is not filled. When they just gain the levels and go above that of 1.3540, I will start moving up the entry stop slowly, maintaining a distance of 30 pips from that of the market. So if they go below that further, then I will be hedged, and I will try to keep stop at entry, and I have booked a profit in the first hedging. The second hedging, I will not book the profit in a hurry. I will wait for the market to stabilize, whether it is making a downward move or an upward move. And depending upon that, I will use the appropriate trading strategy to come out of all the positions with profit at the end of the day. Now I will explain in the event if Euro goes to 1.34, what I will do. I will keep the stop at entry, and I have seen that there was a drop from that of the high to that of the low today, and subsequently whatever the low formed in Euro, if they are breaking it, the low which was formed during European session, if they are breaking it, that means they are continuing the downward move. Then I will try to close the buy position with a loss. So suppose if I close it with say 100 pips loss, or 1.3600 is closed at 1.3500, 100 pips loss. Already I have booked a profit in this of 30 pips in the first hedging. The second hedging will be making another 10 pips profit. So 40 pips will be there with me, and so the rest will be 60 pips loss. In the event Euro drops another 60 pips, I will be able to have a break even. And if they drop it further down, then I will try to book profit in that on the sell side. So this is how we will try to do the trade according to the market moves rather than expecting the market to move as we have taken the position. So the market is making the moves depending upon the traders who have taken the position. That too, it is Friday weekend. So they will try to make up and down, stop and move. And we have to understand that, but they will not drop straight away 300 pips, 400 pips like that. And they are done in the case of Euro, for example. The net change is about 74 pips now. And in the case of GBP, the net change is about 137 pips. So obviously they are not breached the daily limit and they are only making the moves to create the fear. So we will try to capture that particular move as a profit booking opportunity using the hedge. Now what I have done in the case of GBP, I took a buy position 1.5243 during the explanation during the Asian session webinar time and kept a hedging order at 1.5213, 30 pips below. That got filled and I kept stop at entry. Then I booked a profit around 1.5135, 78 pips profit was booked. 1.3105 is the next entry stop and now it got filled. So this is filled. So once it is filled, I will watch whether it is making profit. In that case, I will keep stop at entry. If it is not making profit for 30 minutes, then I understand during the European session, they made a downward stop in the case of Euro. And during the start of the US session, they are making a downward stop in the case of GBP. Just to create the market feel, a bearish feel, and subsequently they will, after a downward stop, and they are expected to make the rise. So I will just take the hedging and see for 10 to 15 minutes, and I will carry the trade during the US session. If this particular hedging is not making profit, then I will try to close the hedging and take another buy position, which is about 100 pips below that of the initial low. Initial buy position. So when I have two buy positions and if the market gains another 50 pips from the low, then obviously I'll have a break even and any further rise I will be able to book profit in both the positions using the trailing hedging order or the stop. When the position makes profit, I will try to trail the stop, and when the position is making loss, I will try to trail the hedging order. So this is how I am going to handle it. I will explain it during this particular US session, the same position, how I am going to handle it. Then with regard to CHF, I took a buy position and booked profit at 1.06 area, about 24 pips. And USDN, I kept a buy order near that of the low, which was not filled. And AUD, I took a sell position because it was near the high, 1.2818, and subsequently closed it with profit at 91.95 around close of European session because I wanted to trade fresh during the US session. And I also took a sell position in the case of USD CAD. I explained why I took it because it was near the high and also they showed a contrarian move of net change positive in the case of AUD as well as net change positive in the case of USD CAD. So I took a sell position and that was closed around 1.0076 with 94 pips profit. And with regard to the crosses, I took a sell position. I took a buy position at 137.90 with an entry stop of 50 pips. In the case of GBP yen, that got filled 137.40 and subsequently it was closed around 136.93 and I kept a new hedging order at 136 with 47 pips profit and I kept a new hedging order at 136.43 and currently market is 136.79 is the low. Still I am not hedged. Then once they rise GBP yen, try to trail the hedging order upward. Then in the case of Euro GBP, I kept a buy order at 89.24 and that was not filled. Anyhow, my decision was correct. It has made the rise as I explained. In the case of Euro GBP, they are expected to make a small rise and subsequently drop during the year session. Anyhow, it has not filled, so I removed the order. So these are all the conditions. So Euro and the GBP, I am holding the pending positions and I will continue the same positions for the US session. and explain how exactly we are going to handle it, so that you'll be able to understand how the hedging can be used to limit the risk and maximize the profit, and also not to become perturbed with regard to the market moves. So now we are watching the US session, and to watch the US session, I will focus the camera over that of the live market code page. You can see that euro has got euro has come down 1.3522 current level 1.352426. The low is 1.2523. They have cut the low in first 30 minutes start of the uh, European US session. So the GBP also they cut the low 1.5094 is the current low. They are holding it near that of the low, and the high is intact. And in the case of yen also they are making a dip instead of rising it as a USD weakening move. The USD gaining move. They are making the USD gaining moves with regard to euro and GBP, and with regard to USD yen they are holding it around the same level. It is in a narrow range. And in the case of USD CHF, they made a net change of 40 pips positive when euro has dropped about 85 pips negative. So this is mainly to handle euro CHF, which is not making any big drop further, even though they showed 1.4318 is the low. A net change is 32 pips negative. Currently, it is firming it up. And euro CHF, euro GBP is also they are firming it up, and subsequently this is the way they handle and make upward and downward stopping for the week end US session. So whatever the move they showed during the start of the session, the exact opposite they are expected to show during the end of the session, US session. So we will just review it for another 5 minutes and take the positions as such. Then I will focus the camera over that of the PowerPoint presentation again. So I will explain with regard to the session timing. Japanese session is 0030 to 7:30 GMT, and the gap time is 7:30 to 8 GMT. From next week onwards, you will come across the European daylight saving system will be incorporated. Then the European session will start around 7:30 GMT. The gap time will be between 7 and 7:30 GMT. Currently, it is partially in US alone. The daylight saving system is incorporated. So you come across the session time from 8 to 13 GMT as the European session, and 13 to 13:30 GMT is the gap time. 13:30 to 20:30 is the US session time frame, and 20:30 to 0030 is the gap time before the next Japanese session starts. So we are in the US session 14 GMT. So we will try to briefly understand the basic trading strategy. What's the forex market in all 6 pairs, 4 majors and 2 commodity pairs, 30 minutes from the start of the session. Already it is 30 minutes over. Now take a sell position if a pair is near the high, but they are near the high, and or cut the high during the 30 minutes of watching, or take a buy position if a pair is near low and not cut the low during the 30 minutes watch. So in our condition now, you find the low is being broken. So if the low is breached, then it has formed a new low. Then we have to obviously wait for the market to come to that of the earlier low in less than 30 minutes. And if it comes above that of the earlier low in less than 30 minutes, then we understand that they will be making a rise. In case if they hold below that of the earlier low for more than 30 minutes, then they wanted to continue the drop downwards. So our trading decision will be based on that. So already 30 minutes is over. At the end of the 30 minutes, they have started cutting the low in the case of GBP as well as Euro. So we have to wait for 30 minutes to take a buy position. And in case if they are not breaching the new low in 30 minutes time of observation, we can take a buy position. In case they cut the low again and try to make a pullback and not going above that of the earlier low, then we will do a breakout trade of sell near below that of the low, so that during the further drop, we'll be able to capture the profit. So in case I have taken already 1.36 a buy position and 1.3610 is a hedging, and in case if that particular market, if euro goes down further, then obviously I will try to keep stop at entry in the hedging order. Then in order to capture that particular swing, I will try to take a sell position near that of 1.35 and try to book about 30-40 pips profit, because I know they will be able to make about 150 pips net change level. So once they make the net change level of 150 pips, then I'll try to close the position. And once there is a distance of about 150 pips between the first buy and the second buy, then I will try to take another buy and try to close when there is a rise of more than 75 pips from that of the low. And during a pullback, I'll be able to exit with regard to the buy position as well. So if the market goes down, I will book the profit with regard to the hedging. And if the market goes up, I will try to book with regard to the original position. And averaging, I will do only with 150 pips difference and not less than that. Not 20-30 pips drop, I will try to average it. That will lead to accumulation of the market. In case every 150 pips, if you try to take a position, that to a mini lot position, if the equity size is small, if the equity size is 30,000 and above, then probably you can trade about 0.5 lots or 1 lot. If the equity is less than 30,000, try to take one mini lot so that you will be able to spread the risk. 150 pips drop, you try to take one mini lot, and definitely there will be a pullback and you will be able to book profit, whatever the positions which is making about 100 to 120 pips profit. And if they drop again, you re-enter. If they rise from there, you try to book profit. That way, whichever way they try to make the move, you will be able to book profit in all the positions during the market cycle. So once you have taken a position, whether it's a sell position or a buy position, keep 30 pips stop if the hedging facility is not available, or keep a hedging order or an entry stop to limit the risk only to 30 pips at a given time. Once the position makes more than 20-30 pips profit, keep stop at entry. That is very important, so that we are eliminating the risk of in the event market goes against us, the position will be closed at entry, we will not make any loss. So the money management, the first step what you have to do is just reduce the risk to nil. As soon as you take that position, because of the spread, you will come across a loss of 2 to 5 pips. And in case if there is further drop against us or further move against us, then the loss will increase. So obviously you have to limit the loss, and we cannot take unlimited loss because our equity is very limited. We cannot trade like the bigger people or the big players taking huge positions. We can only take one position at a time and see that you are able to close it with profit. Then think of another position. Even though I have given the calls with regard to all the currency pair, it doesn't mean that simultaneously you have to take positions in all currencies. They are only for the demo purpose. How exactly you can review the market and try to take positions in different currency pairs, I demonstrate. Similarly, I will do it for the US session also. But don't try to take simultaneously positions. What I suggest is, you try to take a position in euro and try to keep the hedging order. If you are able to stop at entry in that of the euro position, and it is not filled for 30 minutes, and if the going is good, then try to take a position in the same direction, either USD weakening or the USD strengthening move, depending upon the market move, what you perceive. Then accordingly try to take another position. So at a given time, only one position will be put under risk. The rest of the positions you will be having stop at entry, so that it will not lead to over trading. So that is very, very important. And just because you see that USD CAD is all-time low, why not I take a buy position? USD Euro CHF is all-time low, why not I take a buy position? If you try to do like that without any understanding of the usable margin, we are going to block by taking such positions. And also, when they show such level, they are not going to reverse the market immediately. They will try to consolidate and induce all the traders holding long positions to liquidate. Only then they will try to make a rise. So if you try to take a position in a hurry in such currencies, then you may have to wait for a long time. So In that case, you have to understand that you are blocking unnecessarily your usable margins for several days. And the interest applied on such positions also you have to take into consideration. Now, I explained during the Japanese session how the hedging is, the advantage of hedging, and probably I'll read it so that I can take positions quickly for the European US session. Now, hedging is used instead of stop. So you can use the hedging if the hedging facility is available in the trading platform, and in case if the market moves against you, say 100 pips, 200 pips like that, and still you can close your hedging position. You can close the original position with the hedge position, so that you are only having a determined loss of 30 pips, very similar to that of using stop. So suppose you wanted to use 30 pip stop or 40 pip stop, whatever be your type of analysis and the idea of developing the level with regard to the stop, you can use the hedging order instead of stop. And in case you do not know how to use the hedging for your trading, either way trading, you can simply close the position with the hedging order or the hedging position or with that of the entry stop once you find the market is not moving as per your expectation. So you will be able to review after the hedging is being filled, you get the time to review whether your initial decision of entry is correct or not. Because obviously in the market you will come across stop and moves during start of the session and the end of the session. So in that process, if you are hedged, then original decision was correct. Only thing is during stop and it got filled. Now the hedging is making loss and it is not making profit. Then obviously you can close that hedging with a minor loss of 1 to 5 pips or something like that, or by keeping stop at entry. Then subsequently you can continue trading with that original position. That is the first advantage of it. Then the hedging is used to continue trade when the market moves in our favor. Suppose you keep the hedging order, say I taken a buy position in 1.36 level in euro, 1.3570 I kept a hedging order. The hedging order is filled, the market has come to 1.35 area. I can simply kept stop at entry. Once the market comes above 1.3570, I can continue trading because market is not going to continuously drop or continuously rise. It will make up and down moves. So if I wait for another day, I will be able to come out of the hedging with stop at entry. And once the market starts making the move in my favor, I'll try to book profit in my buy position. So that sort of decisions can be taken if you use the hedging. Then hedging can be used for either way trading. In case if you are able to understand how the hedging can be used effectively, so it is like the two type of people in the market. Some traders might be using the making the buy and sell trade. Another type of traders might be doing it sell and buy trade. So in the event if they are doing buy and sell trade and the sell and buy trade, you are holding both the buy position as well as the sell position. So if you are holding both the buy and the sell position, then you can easily use the sell position like a trader who has taken a sell position, and trade with a buy position like a trader who is doing with a buy position. That sort of ideas you can develop, and if you have got the strong mindset, you will be able to understand that market cannot continuously drop and continuously rise. It will be making up and down move. In a day it might be a drop, another day it might be a rise, or 2 days they may drop and third day only they may rise. So in such a situation, you can book profit on the sell side, then subsequently keep another 30 pips hedging order to limit the risk. When they start rising it, you can start rising your hedging order, trail the hedging order also along with that, and try to book profit on the buy side as well. That is another either way trading strategy using hedging. The hedging can be used to reverse the trade when the other way going is good. Say I got a buy position at 1.36 and hedging is filled at 1.3570. 1.3570 is making profit for more than 2 hours. I can simply cut, and more than 2 hours and more than 2 sessions, I can simply cut the buy position with 60 pips loss. Then 30 pips profit will be blocked in my sell side. Then subsequently if the market drops another 30 pips, I'll have a break even. Then if it drops for the 30-40 pips, I'll be able to maximize the profit on the sell side. So you will be able to have the positions to decide whether I'm going to trade on the buy side or on the sell side. Because you have both the positions. Only thing is you have blocked the 30 pips. And that 30 pips, if you're able to earn with that of the holding position, then it is fine. You can even book the buy position with 100 pips loss, but still the sell side will be holding 70 pips profit. So if the market drops another 30 pips, you'll have a break even. And you can wait for 30 pips and close the position so that you don't incur any loss. So this sort of ideas we have to use when the position gets hedged. Then hedging is used to hold the position and continue trading when time permits. In the event of emergency, we can hedge and leave the trade. Suppose I have taken a buy position. Suddenly, I am not very sure whether the market is going to go up or come down, and still the position is not making profit, and an emergency call comes, I have to move out. Then I can simply hedge the position with the market and go and attend to my emergency work or attend to my day-to-day work. And based on the demand, you may come even after 5 hours or you may come even after 2 days. And once you come back, you find that either your buy is making profit or your sell is making profit. And you know that only 30 pips is blocked. And depending upon that particular day trading, you can even book 150 pips loss with regard to your sell side, and the buy side will be making 120 pips profit. And if the market moves another 30 pips in your favor with the holding position, you will be able to come out with no profit, no loss. And if you are able to extend the profit earning by allowing it to increase with regard to the profit, then obviously you will come across net profit. So this particular facility or this advantage will be there. Suppose you are using hedging. You have to, as soon as the position is taken, you have to keep the hedging order. That is very important. And that is trade plan. And in the event of crisis, suppose suddenly the market drops and subsequently you wanted to hedge, then probably in a distress condition, you will be hedging at the lowest level and the hedging may not be making profit. Like a long holder is trying to liquidate the position, subsequently find out that somebody has bought from him at the lowest level at a very cheap price. So that sort of decision, if you try to take it in a hurry as a crisis management, obviously you will find that it's a distress trading. Instead, if you plan before, okay, I'm willing to take only 30 pips risk with regard to my position, then you can keep the hedging order beforehand as soon as that position is taken or a limit order is placed. That is how you should be able to decide upon your trade plan. Whatever be the ideas or whatever be the type of analysis with which you will be able to take a decision to enter into the market or exit from the market, then in such a situation, still the market can move against our expectation at any given time, depending upon so many events happening in the world and so many rumors are being spread and unexpected events can happen in the market and suddenly the market may create a chaotic condition. So obviously we have to limit the risk by keeping stop. If you keep the stop, and that too if you keep about, say, in a risk reward ratio, okay, I am taking a risk of 60 pips, then the reward I am expecting about 100 pips. Okay. Suddenly if the market comes down and hit your stop first and subsequently show the reward, but you don't have the position to take the reward. So obviously it is not the risk reward ratio alone which is important. You have to practically see that instead of stop, if you use this hedging order, you will be able to really understand that the market has made certain chaotic moves on certain occasions just to create fear in the market. And you will not be losing your positions during such time frame. Then hedging can be used to spread the risk. Suppose you wanted to do position trade, every 150 pips you want to take a buy positions. Still, if you try to take about 4-5 positions, nearly about 30 to 35% of your usable margin might be blocked. And instead, if you use the hedging and try to limit in each position only 30 pips risk and keep the orders in the platform and close the platform and go away every 100 pips. So 1.36 one buy order, then 1.3450 another buy order, then 1.33 another buy order, and each 30 pips hedging order. I just occasionally the platform and see what are the positions which are making profit, and wherever the profit is more than 100 pips, I try to close the position and keep further buy orders at the lower level every 150 pips. You will find the position trade will be effectively working for you. So if you want to trade as a long-term trader and not to lose the money using the stocks, then you can think of such type of position trade, spreading the risk and also still use the hedging order. And if you use the hedging order, probably one hedging order you might be losing it about 20-30 pips for loss, and rest of the positions you will be able to make profit. Otherwise, the last hedging order is suppose the lowest level sell, you can take a higher level sell after the closing all the buy positions and close both the sell positions below their average and come out of that. There are various trading strategies available. Only if you apply your mind, you will be able to think about it. And if you think that what is real, only what you are observing now, it is not, then it is a helpless situation. You have to understand the players drop the market and buy from that of the distress, long liquidated, and rise the market to sell their positions. I was telling you, when euro went up to 1.38, that the players are selling, holding the market and selling. So you have to read them and understand that after selling there, they used to make upward stoppers, and such upward stoppers you should make use of to take entry positions, sell positions during such time. Sometimes genuinely they will be making the rise. Then you will be able to easily read by using the live market portfolio that I have been explaining on a daily basis in the Asian session between 5 and 5:30 GMT. So if you attend to those webinars, you will be able to understand how you can read their intentions. Are they going to do the contrarian move? Are they going to make an intentional move? Are they going to make an extended move? And these sort of things you can understand and accordingly take position. Then hedging can be used for breakout trades. Suppose I got a buy position in euro at 1.36 and a sell position at 1.3570, and subsequently market dropped and it is not going above that of my low 1.3570 for about 2 hours. I'll try to take a sell position there, keep another hedging order there, and try to book profit on the downside separately and keeping stop at entry in the original hedging position. So I'm not disturbing the original position, and if the market moves down, I'll take a fresh position and book profit. The market moves up, I'll continue with my original trade. That sort of trading ideas can be developed using the hedging order. Then hedging can be used without additional margin. In most of the platform where they are offering the hedging facility, suppose you are blocking $500 for one lot buy position or sell position in the case of euro, then if you take the hedging, they are not taking another $500 as an extra margin or $1,000 as an extra margin if the leverage is 1:100. The leverage is 1:200, then they take about $500. So you will not be asked to pay additional usable margin when you use the hedging in the same currency pair. So these are all the advantages I think of using the hedging. Then it is up to anybody who can understand the strategies of hedging and make use of it. So in the US session, euro and GBP are expected to make the volatile move and firm up for weekend close. So drop from the high to the low and then rise again towards close or the expected moves. So that is what they have done it. So let us now try to take the position. So currently euro is trading around, let me just focus the camera over the top of the live market code page so that you will be able to understand where exactly the market is. So 1.3519 is the low current level, 1.3513 is the low, earlier it was 1.3524 and they have come closer to that of 1.352 now. The net change is 87 pips negative, and in the case of GBP, they had dropped below that of 1.5129, that was the initial low. Currently they formed a new low 1.5063 and the net change is 169 pips negative, and they are still holding closer to that of the low. Then in the case of yen, they are holding around the same level 90.52 and Swiss franc 1.0618 is the current level. and from the low they have come to the high, they have cut the high. And in the case of Canadian dollar, you find a contrarian move happening along with that of AUD. AUD is showing net change negative, and Canadian dollar is also showing net change negative. Canadian dollar made the drop to 1.0064 and now it is making a rise, and it is expected to go near that to that of the high. When Canadian dollar is making a rise, that means it is showing USD strengthening move, and Australian dollar is showing also USD strengthening move, but Canadian dollar is still showing a net change of 5 pips negative. So that means that Canadian dollar is not going near that of the high, which is in a middle level. Still the net change when compared to that of the previous day yesterday, it is still in negative net change of 5 pips. So when they show net change of negative in both the commodity pairs, understand they wanted to make contrarian move. In the case of euro, they had dropped about 83 pips. In the case of GBP, they had dropped about 170 pips. As a result, euro GBP is going up. So you find that this contrarian move is mainly to gain the levels during the early US session, and subsequently they are expected to make the slide again towards close of the US session in the case of euro GBP cross. Then with regard to euro CHF, euro has made a net change of 83 pips negative, whereas CHF has made only 33 pips net change positive. So when euro has made a net change negative of 82 pips, USD CHF should have gained about 100 pips, whereas it has gained only 32 pips. So they are holding USD CHF and dropping euro. As a result, they are able to rise euro CHF. So you find that euro CHF, the low was 1.4318, and from there they are raised about 40 pips. So this is how they handle from time to time. Wherever the pending positions are there, they will try to handle those positions and try to earn from there and subsequently make them moves in the majors. So you have found the downward stop in the case of euro, and euro has now come above that of the earlier low, 1.3527. It has bid has become 1.3527. So obviously you will find that they will hover around here and suddenly make a rise from these levels after making a downward stop, and when the longs have been liquidated in the market out of fear, they will start. And once the traders think that the market is going to drop further down and take sell position, and they will try to gain the level. Once they gain the level, those who have taken the sell and buy trade, they will try to buy from them. And some people might be doing the averaging with regard to their sells. If they have taken a lowest level sell out of emotion, lowest level, they have taken a sell and find that the market is rising up from there, then they every 34 they will try to sell in order to improve the average level. Subsequently, when they drop, they will be able to book profit. Whereas they don't drop immediately, they continue to rise, induce them to do the short for them. So in the market, you need to understand, they try to make long liquidation, punishing the bullish traders, alternative with that of punishing the bearish traders. So they have to alternatively earn from either of the type of traders. So obviously you have to find what sort of trade is available for us, and accordingly we have to take positions rather than becoming bullish and bearish. Whereas we know that players are making a drop and buying, and when euro and GBP are dropping, when everybody is willing to sell, but who is the wise person who is trying to buy? Or is he wise or is he fool? So they are trying to buy at the lowest level. Afterwards, they quickly gain the levels by circular trade, and afterwards induce a bullish feel in the market, and traders start buying it from them. And subsequently, they don't show further rise, and those who have taken the higher level buy out of emotions, they come and liquidate by weekend. This is what happening every time, and if you understand, then we have to trade along with that of the players, but it may appear we are trading against the trend. There comes the difference between against the trend and against the player. So let me just focus the camera over that of the PowerPoint presentation. I don't have much time to take positions now. I think there is no webinar after this. Probably I can extend it for a few more minutes, I suppose. Then Now in the case of euro, as I told you that they come to 1.3524 level, 1.3513 low. So they have stopped cutting the low for 30 minutes or at most 20 minutes. So I'll try to take a buy position. With an entry stop of 30 pips. And I have another buy position. $1.36 and it has got an entry stop of 1.3510. Okay, so I'll keep entry stop for this particular position as well as the first position 1.36, the second position is 1.3527 and both I kept the entry stop below and around 1.3510 and around 1.3497. Then subsequently when the market started moving up, I will try to keep stop at entry in the second buy position so that I eliminate the risk with regard to second position and trail the stop in the second position and trail the hedging order in the first position. And once I am able to see above the average level 1.3527 on 1.36, the average will be around 1.3560 area 65. Then once the market goes above that, I will try to trail the stop tight in the second position and try to trail the hedging order in the second position. And if they dip, I will close the second position. The first position will be hedged. Then when they drop again, I will try to take another buy position. So I will not accumulate position. Whenever the position makes profit, I will try to realize the profit. And I know that market keeps giving opportunities and try to re-enter again buy when they drop another 20-30 pips at 1.3545 or 42 like that. Then subsequently trail it up again, keep stop at entry in the second position and trail it up. This way, every swing in the market will be able to capture without any stress. We will be able to handle both the positions. So in this, you need to have the hedging facility, trailing stop facility in the trading platform. Then you will be able to do it very effectively. And ultimately, the trading strategy is going to help us rather than any type of market analysis we try to do it. And in that certain and it has been estimated, most of the statistical analysis give 70% probability of success. So obviously, if you happen to take positions in the 30 pips of error with regard to the statistical calculations 2-3 times, then you will think that particular statistics is not working properly for you. Then you look for some other statistics. Ultimately, in the statistics, you do not come across the time frame in which you have to take entry and time frame in which you have to exit. None of the charts will indicate that, and none of the statistical analysis will indicate that. So obviously, if you have taken the position at the wrong time, that is why I give importance to that of the timing and displayed it in the slide. What are the session timings which are followed by that of the players? So during the session start and during session end time, they will make that upward and the downward stopping. And during the gap time, they will make a false move, and opposite to that will come across in the session first 30 minutes. You would have noticed Euro and GBP, they formed up during 13 to 13:30 GMT, and subsequently they made the drop during 14 to 14:30 GMT. Sorry, 13 to 13:30, 13:30 to 14 GMT. So that is how they will try to make the moves. So you have to understand what sort of moves they are going to make it, and accordingly try to take the positions at the end of the move or before the start of the move. Then you will see definite profit booking opportunities in the market. Then in the case of GBP, they have formed a new low 1.5063 and currently it is trading around 1.5075. So it is not cut the low. So I will take a buy position. With an entry stop of 30 pips. I have the original buy position. $1.5243 with an entry stop. I booked the profit and subsequently the entry stop is filled at 1.5243. 1.5110. So which is also making profit. I kept stop at entry here. And once this particular position makes profit, I'll keep stop at entry in this, and automatically the entry stop will be filled, and subsequently when the market goes up, so that I will be able to trail stop in the second position, and I'll try to trail the hedging order in the first position, maintaining 30 pips from the other market. If it's hedged, then again I will review for 30 minutes, and if it is not making profit, then I'll try to cut the hedge 10 to 30 minutes. If you watch, you'll be able to really judge. Once you earn experience out of that, how to handle the hedging, then you will be able to judge within 10 minutes whether they are going to drop or is it a stop point. Then accordingly you can handle the hedging, then subsequently trail up till they go above to that of 1.5243 and book profit in both the positions above 1.5243 if you have got a patience. Otherwise you trail the stop, and once the second position is closed, then if there is another drop, try to take another buy position and trail it upward. And if it is not going below 1.5110, during that process, you understand they are just making a downward hit to hit the trailing stops before making a further rise, so that you can understand re-enter in the market and continuously trail up the hedging order to close the buy position as well. And it's a question of position trade, and you have to patiently wait and do it. You will be able to see the real success. In case if you want to do the intraday trade using hedging, simply once this particular 1.51, I took a buy position at 1.5243 and 1.5213, it was hedged, and that was making profit for about 2 hours. Then I simply cut the buy position and hold the sell position and try to maximize the profit with regard to the sell position. That becomes the intraday trade. So this is how you should be able to judge with regard to the position. So I don't have much time to explain with regard to taking further positions with regard to this particular session. Probably I will review the market and take up the questions which are asked here and explain the trading strategy. I'll minimize the power session, focus the camera over that of the live market code page. Okay. The Kananas, Doctor, are you counting 23 pips of profit with the hedge position closed in 30 pips? No, I will not try to close book the profit like 20 pips, 15 pips like that. And I will watch the market and accordingly try to close it. Because see, I am of the opinion that we should take very less position and try to maximize the profit as much as possible rather than trying to do some scalping. Okay. Can you explain the reason knew it? Closing the hedge at GBP at 1.5135. I have not closed the hedge. I kept stop at entry. I have taken a fresh position at 1.5075, and currently market has come closer to the low 1.5062. Let us see how exactly they are making the move. So they may make a false move. If they don't cut the low for 30 minutes, then be sure that they are not going to cut it and they will make the rise. So on a 30 minutes time frame, they will make the moves. You have to read it carefully. And that too, it will be following exactly the GMT time. So 14:30 to 15 GMT, they will be hovering around. From 15 to 15:30 GMT, they will be making a rise. You can watch that. Then you will find the GMT time, and tracking the market using the GMT time is really fascinating, and also you will be able to find that it is an easy way of tracking the market rather than following the charts and trying to find how exactly the trend is going to be for a long time. But we are focusing on the intraday trade. Okay, do you trade yen pairs often? If so, which session is the best for trading yen pairs? As far as the yen pairs is concerned, Japanese and the US sessions are the best times to take positions. Whenever the spread becomes more than 50 pips, in the case of yen, try to take positions. Otherwise, they will between the low and the high. Otherwise, if you take a position, you can only book profit of 10 pips or cut it with 10 pips loss. Then it seems that USD CAD made the most gain. Can you give your views why it is? So as far as USD CAD is concerned, they made a quick downward stop on during the European session. And when Canada is active, and they said that because of the Canadian economic conditions, US CAD has become very, very strong. And within a matter of 1 hour, it has become weak again. From that low of 1.0064, it has come to 1.0144. You can understand how the economy can just become weakened within 1 hour. So these are all nothing but the trading game, and if you try to relate to the economy, then you might be really find it as a puzzle. And USD CAD, they are making a downward stop, and they are expected to make gains very quickly, probably towards close and also during next week. Okay, then. When could we see 1.38 in euro? As per my estimation, actually, I did not anticipate on Monday. You could have listened to my Monday webinar. Then I was expecting them to go to 1.40 in the case of euro. And subsequently, I found that they are selling on Tuesday onwards. So after gaining the levels, they started selling it. Then I had given that update that they wanted to make further downward stopping, because after the rise, a lot of traders have taken the buy position in those currencies. So when they have taken the buy positions, obviously there is no point in rising the market, and they will simply say that it is the Greece concern and things like that. They will drop. Only then they will be able to earn. Ultimately, the players are interested in earning their money. So it is not that they wanted to show a higher level or show a lower level and things like that. Their objective is very, very clear. By dropping or rising the market, will they be able to make money from that of the emotional traders? That is what they are trying to do it, and we have to understand. And they will make the market appear it is respecting the channels or respecting all the statistical analysis, and suddenly they will say due to fundamental it has breached that particular channel formation and it has reversed. So like that, they will try to give explanation that market has followed the technicals on one time and followed fundamentals on another time. So as a trader, we won't be knowing in next 1 hour whether it is going to follow fundamentals or it is going to follow technicals. So that is how they can easily fool around the traders. Ultimately, what they want is earning money from the other traders. And now GBP, you find that they have broken the low by another 30 pips. So my hedging is being filled. So I will wait on the second position. So first position hedging has not been cut, and I kept hedging order, stop at entry. The second position also I will try to keep stop at entry and continue the trade. That because I don't have much time to explain till end of the year session how exactly I am handling the position. But I will keep the stop at entry. Once the stop is being filled, then when they start rising it, I will keep the hedging order below that and start trailing it upward. If not today, on Monday I will continue to trail the stop and try to do it. In case if they drop further down, then I will wait with the hedging and try to maximize the profit of 150 or 250 pips with the help of the hedging. Then keep another 30 pips hedging order below that. And this sort of thing you can do it only if you have the hedging facility. Otherwise, nobody will feel like selling at 1.5044 and seeing that okay, they can go to 1.49, etc. It may show technically that it can go to 1.48 or 1.47, but I am very sure not many of the traders are taking sell positions, even the institutions. That is why the players are dropping it and easily earn from all the people. Even though technical analysts might be telling that market is going to drop and it is in a downward channel, but people are not willing to take lowest level sell. They try to take a buy position, and in distress condition they try to liquidate. And the players know the limitations of the traders because their usable margin does not allow them to hold the position for a long time, and they just drop like using circular trade and try to earn from that. And that is the one reason that people or the platform do not want the traders to use the hedging. so that the traders will not lose the money. They will simply hedge and call that. Can you explain the Euro GBP deal again? You buy, take loss, buy again, loss again, and order to buy again at 3510. Is it right? No, I am not taking subsequently loss. I keep the hedging order. I took a buy at 1.36 and a hedging order at 1.3570. The hedging order was making profit, so I booked profit at 1.3540, and subsequently 1.3510 I kept the hedging order. That got filled now because the new low is 1.3509. I'll watch for about 30 minutes again when they cut the low, and if they are not cut the new low, because they have started cutting the low from the start of the session, I have to wait actually for 2 hours for them to complete the extended move. Then afterwards, if I cut the hedging order, then I'll be able to see that my hedging order is not filled again. So I will try to book profit in the hedging and keep another hedging order and trail it up when they start gaining the level. So that is how you continue to do it in a very mechanical way. You try in a demo trading platform. If it works well for you, you can use it. I am not compelling you to use it. Okay, and then what could be the worst scenario with the hedge? Maybe they cut the hedge in 30 pips and that is the position goes back and exits at break even total 30 pips. Yes, the worst case scenario, you close the original position with the hedging, accept 30 pips loss. Do you look at charts, and if so, what time frame? Okay, I stopped using the charts. I have been doing it for 12 to 15 years using various types of statistical analysis. Not only these things, what you hear it in various webinars, etc. That is what I also attend to other webinars, whether anybody has come out with a new ideas with regard to this chart pattern and with regard to the chart analysis, other than the fib retracement, etc. People have not gone forward. And I done various other type of analysis like principal component analysis using the charts and also the cluster analysis, and not only taking the standard deviation, I have also taken into consideration the normal deviate, etc. The standard deviate, normal deviate, and the proportion exponential deviate. All the methods I tried, but nothing has got 100% success because it does not give the time frame in which the market is going to move against you. So as long as the time is not being specified in the chart study or any other study, I thought that it is important for us to understand the timings of the market. And it is a man-made market. Only if the men move the market is going to make up and down moves. If everybody is watching the market, it cannot move on its own. It is not God's creation. It is men's creation, and they know the market is created in such a way so that the people can always go in for the confusion whether it is going to drop or whether it is going to rise. This sort of uncertainty is continue to prevail in the market from time to time. So in such a scenario, market cannot continuously drop or continuously rise indefinitely. It has to make the reversal point at any time frame. So I spent my time in analyzing the market timing. So with which I developed the algorithm which gives the market timing which has got nearly about 85 to 90% accuracy with regard to the market timing. And now you come across a new strategy in the market, that is contrarian moves. And normally if you go back to that of before 2000 to 2004, they never used to make contrarian move. If euro rises, definitely GBP will also rise. And if euro rises about 100, 120 pips, then GBP might rise about 200 pips. If euro drops, GBP will also drop. That sort of scenario was seen. But now you find euro rising 100 pips, GBP dropping 250 pips on a single day. This sort of contrarian move is seen in the market very often. And similarly, when euro and GBP are dropping, USD yen is also dropping. The contrarian move. So I am trying to fine tune my algorithm in order to fix this particular contrarian move because they are spending more time in handling the crosses rather than handling the majors. In such a situation, we need to really understand that which currency pair they are going to make the move at the current given time. Then accordingly, you have to take trading decisions in their respective currency pair. Suppose I would have taken from morning the buy position in Japanese yen or a sell position in Japanese yen, I am not making any money. And even in the case of the yen crosses, you would have noticed that if you have taken a buy or a sell position, hardly you make about 20-30 pips profit. But normally people take positions in the yen crosses, aiming that in a given day we can easily book about 30 to 50 pips or sometimes 150 pips profit. Right? But sometimes they hold those currencies and focus on certain other currencies. Because where the pending orders are there, accordingly the players are making the moves in the market. So this we need to understand. That is why I developed the algorithm with which I try to find out the intraday time frames as well as the long-term time frames during which they are going to make the specific moves in the market. Accordingly, I am trying to give the analysis. And moreover, I am giving it in my blog. You would have noticed that Euro and GBP are expected to rise or expected to drop. Only these conditions I am giving it without giving any substantiating statistical analysis. For the simple reason that the substantiating statistical analysis is mainly to say that I am not the culprit, only the statistics is the culprit. In the event if it goes wrong. No, it is using a disclaimer. I do not want it to do it that way. Instead, I wanted to go with that. In case if it goes against, then use the trading strategy to limit the risk and maximize the profit. So ultimately, a 100% trading solution is necessary for anybody to take a trading decision. And with 90% success or 95% success with regard to statistical analysis, and in case if you try to take positions during the error time, then obviously you are going to lose that. And that error time, in case if they make a very big move in the market, then obviously what you have earned using that normal statistic, you would have just lost all the money in that particular error time frame. So obviously any trader is looking for an error-free statistical analysis, thereby they will be able to successfully and consistently earn from the market. So I am trying to focus only on that. So hence, I am perfecting the analysis at the same time insisting upon the trading strategy. But now, unfortunately, in US trading platform, the hedging facility is being withdrawn. I don't know what could be the reason for that, and subsequently, first in, first out, and all introduced. So even an averaging trading, the second position you will not be able to close. So any type of trading, simple trading strategy, you try to do it, and they are trying to curb it. I think that is a way to help the people, I think. Then balanced. One question on hedging. When you put stop at break even, if hedged, you must wait for enough distance or market may take the break even position and then you will not be hedged. But market continues to direction of the hedge. No, it is not like that. Once we keep the hedging, stop at the entry in the hedging, and once we have stopped out, the hedging is stopped out at entry, immediately we will keep 30 pips below another hedging order and trail it up. So we will not expose the position without any hedging order at any given time. Okay. Then Ahmed, I have a floating loss of 116 euro and US. Now, when there is a floating loss, then obviously, you have to use the hedging to limit it, and you have to see that you are not getting a loss which you will not be able to bear it. So you have to understand the limitations of the usable margin, or accordingly you have to use the hedging or cut the position, stop it out. Then when the market is not moving as per your expectations, don't hold a loss-making position for a long time if the usable margin is very less. Then, do you see Euro 3200 and it has come to 3500? So I am not expecting a very big downward move, and in the case of Euro and GBP, they are trying to just hover around here in order to create the feel that it can go down deeply. But they are buying. So If they are buying, obviously, say at 1.38 they have been selling, I noticed it, and now they are dropping. Every time they drop only 25 pips, and subsequently they are supporting it, and that you can easily find it in the live market quote page. They show the red quote for about 2-3 times, then subsequently green quote comes in. That means they just make a chocolate trade and drop the market, and subsequently they keep a higher level buy order and buy all the sells. That's what they are trying to do it. So when they are buying, obviously they will try to raise the market and book profit again. Then, are you still sure that they are on a butt trend? No, they are making a wide range consolidation in this particular range in order to make an upward breakout. Then new age position trade. Do you say that leave buy order every 150 pips with a hedging of 30 pips away and take profit on which order every 100 pips, the primary position or the hedged position? Once you keep the orders and also the hedging orders, 30 pips, then let them drop the market during a trending. Suppose you have got a buy position at 1.38, you thought that it will go to 1.40, you have taken a buy position. Then another buy position at 1.3650, another buy position at 1.35, and similarly, you will keep the buy orders. Everywhere you will keep 30 pips hedging order. If the hedging is filled and if it is making profit for 2 hours, then leave it as it. Keep another buy order. Let them continue the trend. And you try to keep stop at entry in the hedging. So that in case suddenly they reverse, then all the hedgings are closed. The last hedging is closed. Then you are able to continue book profit in the hedgings to start with. And one by one. And close the buy positions. That is how you have to handle it. And you should not close all the hedging at one stroke. You have to close one by one the hedging. The hedging position you can book profit, then the original position. Then the hedging position you can book profit and the original position. Suddenly if they drop, then again take another buy position and keep hedging. You can continue to do like. Do the players have enough money to move the market? Yeah, they have very enormous money, and the world richest people, their money they wanted to multiply, and they want that money to earn at least 15 to 20%. Which bank can accept it as a deposit and give them the interest for that? And now with the prevailing interest rate, they will not be able to earn. So out of greed, such people, they try to invest it in the private arms of the banks and dictate the banks to do the trades for them. They become players. And they always see the sense or the pulse of the market, and just to say against that you do it. That's all. So we need to read their intentions. Otherwise, no fundamentals or no technicals will work. And it may appear the market is following that, suddenly it will reverse, and you will find that these greedy people can rise the market anywhere. So, and that Canadian dollar, for example, and it was trading around 1.03 for a long time, and 1.03 to 1.07. Suddenly they dropped it. And do you find really Canadian economy has grown up so much? And they said the oil has gone up. Oil went up to 140. At that time, Canadian dollar was not trading like this, and it was trading at 1.23. And now the Canadian oil has gone out to 81, 82. What is the big deal of telling that Canadian dollar has become stronger because of oil? And similarly, gold is related to that of Australian dollar. When gold went up to 1,228, Australian dollar was trading around 92 only, and 92 to 94. And when it has come to 1,100 also, it is trading in the same way. And so if you try to relate all the currencies or try to relate all the markets, it may appear they are all related, or they are showing the trending move in a similar direction. But they are all nothing but coincidences. And no fundamentals can continuously explain it. See, if it is a fact or a statement, then the statement should work in every market condition. If it is an opportunistic statement, okay, now you find similar patterns with regard to the charts, we can always say that they are related. Look for this particular market. Earlier people said that the stock market is going up, so Euro and GBP should go up. Now what is happening? When stock market is going up, Euro and GBP are dropping. So immediately they will forget about that coincidence. Think of alternatives. Those who have been in the market for a long time, they may be knowing that sorry, Dow was related to USDN in 2000 2001. Whenever Dow goes up, immediately USDN will also go up. That sort of moves they have been relating, and nobody talks about it now. So if you are a long-term trader in the market, you know that every time they will try to create the hype, and that hype will be having its own time frame, and subsequently you find that it is being replaced by some other thing. You know that carry trade came as a hype. This sort of hypes are bound to happen in the market from time to time, because every time they will make a specific type of move and try to give a wording for that. Then Abel, earlier you were saying if after 30 minutes we watch and we see lower low, do you join in that is take sell position? Yes. When it cuts the low after 30 minutes and stay below that low, then I will try to take a sell position as a technical trade. But I explained I had taken a buy position because it came above that of the high, initial low for this particular session, euro 1.3527, and that is why I had taken a buy position. It was staying there, and I kept the hedging order to limit the risk in it, 1.3497. Then Ermelinda, are there any guidelines for where to place a stop loss on the hedge if you are not able to monitor it closely, assuming that it goes against? Yeah. See, whenever you are taking a hedging order, you are not able to take a decision, you can keep 30 pips stop in the hedging order. Suppose you have got a buy position and sell position, you do not know which direction the market is going to move, then keep 30 pips stop in both the positions. If the market comes down as a downward move, then your buy will be closed with 60 pips loss, and 30 pips profit will be blocked in your sell position, and another 30 pips if the market moves, then you will have a break even, and another further 30 pips move, then you will be able to make net profit. And if you are not able to read the market, but understand that we are trying to take the buy position near that of the low. So 1.35, we are trying to take the low. Okay. Yeah, I will finish. Okay, 1.35, we are trying to take the low. Then 100 pips net change already seen. So obviously, you can see only a downside move of another 30-40 pips. So you cannot try to double up and things like that. I think the time is up. I will not be able to take all the questions which are asked here. Then I will again come back on Tuesday and take up the Asian session live market analysis, and I'll take up those questions which are asked here, and I'll try to remember those questions and answer. Otherwise, you can place those questions on that time, and I will certainly answer to those things. So I'll focus the camera over that of this PowerPoint presentation. So euro, I have taken a buy position at 1.3527, 30 pips below the hedging order is there, which is not filled. Whereas in the case of GBP, 1.50275, I have taken a buy order. The hedging order is filled at 1.5045, which is making profit. I can keep stop at entry in that. And 5110 also, I have kept stop at entry. Then once the market moves in our favor, we will stop out. And once 1.4045, 5045 is stopped out, then I'll try to book profit in the second hedging order. Try to trail the hedging order for both the positions and try to close it above that of the high. So this is how the trading strategy can be developed. If you do it in a demo trading platform, you will be able to find various opportunities of using hedging, or without hedging, if the platform is not offering hedging, still you can develop the trading ideas, then enter into the market. So I take this opportunity to thank everybody and also Apex Trade for listening to my Tracking the Forex Market Together webinar. Then again we will meet on Tuesday and review the market from time to time. Thank you all. See you again. Bye.